So CPI just came out. Surprise, surprise, it was much hotter than expected. Now, not only was this last month much hotter than expected, but if you take a look at the last 7 CPIs, 5 of the last 7 CPIs came in hotter than expected. As a matter of fact, only one, which was November 14th, 2023, came in lower than expected, and December 12th was the last time that CPI came in line as expected. Now, we are talking about headline CPI year over year. However, the stock market continues to go higher. Now, last year, around October's timeframe, is when I did a video explaining why I think that we will get a surge of liquidity back into the market and why we are likely at the end of this 2023 correction and we will likely get a bull run. But how do you justify now continuous CPI reports coming in hotter and the market completely ignoring it? If you remember 23, 22, 2021, CPI used to affect the market quite heavily. If it was good, the market would rally. If it was bad, the market would tank. But I don't think that this is necessarily at this point. I don't think it's necessarily dependent on CPI. There is something much more important at work here. So in this video, I'm going to explain to you what is really underpinning the continued rally in the stock market, why I'm continuing to sell some of my stocks here. And because this is an extreme scenario, you've probably talked to your Uber driver or watched CNBC or talked to your dad or talked to your friends, and you guys can't stop talking about how inflated the stock market is. This is an extreme scenario, which means that there are likely opportunities somewhere to be found. So I will tell you in this video, I will hint to you what I am rotating into. Like I said, I'm selling some of my stock. And to be clear, this is some of the stock that I bought at the bottom of this last correction here. And I will give you some insight into what I'm investing in now. So you definitely want to stick around till the end of the video. Let's get right into it. So first, let's talk about the CPI report. As I said, the headline CPI came in hotter than expected. Even core came in hotter than expected, but headline coming in at 3.2 versus 3.1%. Now, if you've been following this channel, you know that as we get closer to the finish line, right, the Fed's magic number is 2%. So as we get down to the incremental digits, the 4% down to 3%, down to 2%, that is going to take a long time. And I know this because we have history telling us so. In the past, it has taken years to get down from 3% to 2% or below. Now, the reason for this is because as we get closer to the Fed's inflation target, we tend to see a new wave of enthusiasm. And if there is liquidity that supports that, then you will likely see assets inflated once again, right? Because right now, as we get down to near that 2%, there is exuberance that not only is inflation kind of under control, which if you ask the average American, of course it's not, but also the expectation that the Fed is going to cut. And the market still thinks the Fed is going to cut, even though we are getting stronger than expected data. So let me show you something. And this completely blew my mind by looking at the FOMC watch tool. This tells us what the expected Fed funds rate is going to be based on institutions betting what it is going to be, right? So this is sort of a probability meter. And by the way, it is rarely wrong. So for the March meeting, March 20th, the market is expecting the Fed to actually skip. Is this a surprise to anybody? No, it isn't. As a matter of fact, this is how it's been for quite some time. Even a month ago, this was at 84%, that the Fed wasn't going to cut rates. However, where things start to get interesting is in May. In May, now the highest expectation is that the Fed will skip also because the data coming in is really hot, including the inflation data. Now, a month ago, this was at 39%, as you can see here. But now it is at 87% that the Fed is actually going to skip. Here's where it is interesting, is that in June, for some reason, with much higher data, there's more of an expectation now that the Fed is going to cut than there was a month ago. That is wild. So a month ago, there was a 41% likelihood that the Fed was going to cut to 500 to 525 basis points. A week ago, it was 59.2%, and now it is 59.7%, even in light of stronger than expected data. So the market is still expecting this. But obviously, this right here is driven by a liquidity story as well. The market runs on liquidity, and the market wouldn't do this if there wasn't excess liquidity in the system. You guys all remember what happened in 2020. For those of you that have been around, you know that every time the Fed eases, we tend to get a surge in market activity. Now, to me, even though the S&P and the NASDAQ look like it is kind of losing steam here, no, that does not mean short the market or that the market is going to tank, but it just means we are kind of basing up here. The market can continue to inch up up higher until we get closer to recessionary markers. We are starting to see them pop up. Like if you look at gold, for instance, gold is on a historic rally, and gold recently just hit its major trend line that it established in 2022. Sorry, this trend line is actually from 2020, but you can see it here. Gold is on a historic rally back to one of its all-time trend lines. These are the types of things that you tend to see before recession. So to me, it is not really overly surprising here, right? Like if we go back to 2007, we had a very similar market rally that started in June 2006 when there was an expectation that the Fed was done hiking. This was actually their last hike with, ironically, the same exact Fed funds rate that we have now at 5.25%. This was their last hike. So we tend to see these rallies when the market knows that the Fed is done hiking. So we had this exuberant rally where there were barely any red weeks, and then we had a correction in February 07, a little bit more of a rally before topping out in October 07, and we all know that that is where one of the worst recessions in the US history started, right? Now, please, I'm not comparing this to 2007. I just want you to see that this type of behavior right before the worst calamity ever, and I don't think we're near that type of calamity at all, but right before the worst calamity ever, at least since the Great Depression, you tend to see this same type of behavior where the market rallies exuberantly, a small correction continues even rallying some more, completely capitulating all of the bears because the market knows that this was the peak rate, just like we are now. The market knows that last July was the peak rate. And here was July, we got a correction and now an exuberant rally. And we will for sure get a correction at some point in the near future. I would say probably within this month. And if you take a look at gold at that time, gold also went on a 30% rally too before falling victim to the recession, although it did not fall as much as equities did. Now, before I get into a little bit of investment strategy, where I'm putting my money now that I'm selling off some of the stocks that are inflated, I just want to give a brief nod to what kind of liquidity is driving this rally here. If you're a fan of economics and Fed policy in general, then you probably watched a lot of videos that pertain to the Fed's reverse repo facility. Now, the Fed's reverse repo facility continues to dwindle. As a matter of fact, this is from November 2023, and it was under $1 trillion. It is even less than that now. So just real quick, the reverse repo or the reverse repurchase agreement is basically a mechanism that the Fed uses to extract liquidity from the system. So in this case, you have all these banks, and basically the Fed gives them a nice little reward. Let's just say that this right here is the Fed. The Fed gives them a nice little reward for them sending all of their dollars to the Fed, so the Fed can actually take liquidity out of the system. So all these banks here are sending their money to the Fed in exchange for basically de facto loans. That's the long and short of it. Now, the Fed was piling up this money here, trying to take liquidity out of the system. However, banks recently have shown less interest in this and have actually been putting their money in private securities because they can get a better return than what the Fed is offering. And hence, the balance of the reverse repo is falling under. Now, why is this important? Well, because if you take a look at it from a surface level, if the money is not sitting here with the Fed, that means the money is out here in the system. Moreover, the Fed has a long way to go. So ever since 2020, the Fed added $5 trillion of liquidity on their balance sheet, and they have only really taken off $1.5 trillion. All this liquidity is still sitting out there. So even though I'm looking at this market here, and just like you or anyone else, I am obviously a little bit squeamish about these levels and about the fact that this run-up happened without really any, not even a pullback, let alone a correction. The fact of the matter is this thing can continue trucking up until we hit a recession. Now, as I said, I do think we will see a correction in between here and then, but this thing can actually continue inch warming up, even though probably in fits and starts, probably a little bit ugly and not, you know, another 15 or 20% of a straight up rally like this. But with that said, it becomes a race between the Fed's policy and the economy. So is the economy going to crack under the Fed's policy first, or is the Fed's policy going to be so effective at reducing all of that liquidity, bringing inflation down to 2% without the system breaking first? History tells us that is not really been the case ever. Now, if we get a recession or some sort of shock to the system, well, then obviously the party's over for everything, including the stocks that I am about to rotate into. So this is why for me, I think that right now it is a stock picker's paradise, right? Like before this, yes, I think that, you know, putting your money in the SPY or QQQ, at least in my opinion, I think you were fine then. right? But at these levels here, again, very hard, at least for me, not to be squeamish. So I would much rather take my chances with something that hasn't really rallied yet. And I'll talk about what that is, because right now and always I'm looking for asymmetrical bets, one where the odds are not stacked against me. And I think buying obviously the SPY at 516 or 520, the odds are probably not in your favor. So what am I investing in? As I've said before, IWM is probably the best value out of any index here. Now, luckily, we've been in IWM since November. I'll show you the alert in a second, but IWM rose 23% since November. However, it is still quite a bit away from its all-time high. It's still almost 20% away. So what tends to happen in bull markets, before a recession, is small caps will eventually follow the mega caps, the large caps, right? So this IWM, which is the Russell 2000, will eventually follow the way of the NASDAQ and the S&P. Now, obviously, as I said before, nobody in my view can predict a recession or a black swan. So yes, it could be the case next month that something cracks under the system, commercial real estate goes kaput, and then everything crashes, including IWM, right? But for me, that is why I'm looking for asymmetrical bets. Like, would I rather buy the SPY at all-time highs and take my bets with that? Or would I rather buy something that typically rallies, still has about 20% to get back to all-time highs? And if we avoid a black swan in the process, I will likely see exponential returns from that. Well, obviously the latter, for me at least. Do what's good for you. So if you look here, November 10th is when I bought IWM, and I bought it for a few reasons. But one, if you look at the monthly chart, it was at the 50% retracement of the last rally from 2020. All of the headlines were saying that small caps were doomed. This is the worst small cap market of all time. That right there raises my antennas. Whenever I hear someone say this is the worst XYZ of all time, I really want to go into that. And obviously I had further analysis like this right here being a fractal, a repeating pattern that happened back in 2008 where the small caps did rally, retraced to 50% on the monthly chart before rallying again, and it seemed to happen yet another time. So I was very comfortable with this price point, and like I said, I'm not bottom hunting, but I'm looking for asymmetrical bets. This to me was a clear pie in the face. Is that even the right analogy? No, I don't think so. But it was a clear opportunity. November 10th got in that. And I still think that there is an opportunity here on pullbacks. We got into Celsius at $49. I'm not looking to get back in this because if you look at Celsius now, well, it is currently at $91 and we got in at 49 bucks. There's the alert there from December 12th. It had the standard drop after the stock split, which is, these are opportunities that I love. And I wish that Walmart dropped a little bit more after the stocks, but it had the standard drop after the stock split, filling this gap here. And there were rumors that Pepsi was going to acquire it, and they still could. They did invest $500 million into Celsius last year. I did get some of my shares called by a covered call, and I also have leaps on Celsius. As a matter of fact, the only stock that hasn't made money for us since last year that we bought into, because I'm very selective about my buying, was PayPal. It is still up because PayPal, as of the time of this recording, is 60, and I bought it at 55, but it hasn't really performed like I wanted. So besides IWM, what else do I like here? Let me just pause and tell you that if you want to get all of my insights in real time so you're not watching them late here, make sure that you sign up to our monthly Discord using the link in the description below. No other group is doing stock purchases, analysis, day trades as well on futures, option selling, etc. No other group is doing that. I guarantee you, not to the extent that we are doing that. And that way you could have got Celsius at 49, you could have got IWM 23% ago. So the other things that I'm looking to rotate into, TLT, I liked it here at the 50% retracement of the last rally. You can see most of the volume is centered around 94. Got back into TLT, added a little bit more at 92. If the Fed is going to cut and the market is taking them at their word, then we are going to take them at their word. And I think as soon as the Fed cuts, you will start to see, obviously, interest rates drop. You might already be getting notices for offers on your mortgage to refinance at a lower rate. I would personally hold off on that until they start cutting rates, but that's another story. I also recently swing traded 10-year futures, made $1,000 per contract on that. Google, to me, is actually starting to get cheap here. And I think that this drop, because of their woke AI issues. For me, I love when companies face a PR issue and there is an over exaggeration in their stock price, right? So Google, in my opinion, there wasn't a reason for it to be down 14%, especially if it's seen as an AI play. So I was happy to pick up Google, issued an alert for it when it was down here. I still think that it's at a decent price compared to the rest of the Mag 7. Like I said, if you're part of the group, you would have got the real-time alert. Tesla is an obvious one here. I still think Tesla can have some more downside, but I'm okay rotating it to Tesla here. If you take a volume profile tool, and I like doing this when I'm in the process of long-term investing, if you take a volume profile tool and just go back to its bottom all the way down to 100, where you think there would be a ton of buyers, most of Tesla's volume was actually at 253. If you take it back 2 years, so January 2022, most of Tesla's volume is around 248. So right now it's trading at 177. You do see that there is bullish divergence between the RSI and the price. I do think it can drop $10, $20 more. I don't know if it will, because we did get an oversold RSI with a bullish divergence. This could be the extent of it, but you do have a couple more volume shelves here between 173 and around 160. And then dollar cost average into Apple, 15% down. I think Apple has not even announced its AI plays yet. So oversold on the RSI once again. And I only really use the RSI for long-term investing. I don't use it in day trading at all. I think it will make you go broke if you try to use it in day trading. Again, that's another topic. But 15% down, comfortable dollar cost averaging into Apple. I don't know if this is the bottom yet. It really depends on when they strategically release their AI roadmap. And then as a hedge, I do like VIX calls. You guys know this. I told you guys last time, VIX calls at 13. That is a no-brainer. And the VIX ran from 13 all the way to 16. We are talking about a percentage gain on the VIX of 22%. These calls would have went crazy. So waiting for it to fill this gap again here before buying calls, probably dated 2-3 months out, just to catch any potential black swan event or some sort of Volmageddon event. Anyway, traders, that is it for this video. If you got something out of this, leave it a big fat thumbs up. If you want to work with me personally, this is a new program that I'm opening up to a select few. Most applications will get rejected. It is definitely expensive, but I will value your time as you value mine. So if you want me to review your trades personally, tell you what I would have done different, tell you what you did right, what you did wrong, make sure you click the application link below. I only want to work with serious qualified people, so please, if you're not interested, don't apply. And if you just want to join the monthly, that's cool too. Use the coupon code below. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.